Patrick Bennett. Patrick is a strategist at CIBC. Well, what do you make of it all? Greece ain't out of the woods, though, is it?
Absolutely not. I mean, I think we get all these bouts of relief, or people call it, risk on, and it's really only disguises what the underlying problem is. The underlying problem is not going away. We don't know what this, the ultimate solution is, but we know the solution. Ultimately, it's going to take, 5, perhaps 10 years for this all to work its way through. Yeah.
So, what does this do? Is it just again borrowing time?
Well, I think it's borrowing time, and I think trying to say that look, we can paper over the cracks is not a good thing to do. And what we need to do is we need to find a level where assets will clear. Those assets are going to clear at levels of prices which are much below where we are now. They either need to be the asset prices need to fall, or we need the currency to fall. One or the other. We need to find somewhere where there's a willing willing balance of supply and demand.
Patrick, what does it all mean for the euro? We saw a bit of an uplift in it, but we've had recent declines. But it surprises me how resilient it has been nonetheless.
Yeah, I mean, absolutely. I mean, I think if you look at euro-dollar, it has been resilient because people look at the US economy, the European economy, and they toss a coin and say, well, which one do I dislike the least? But I think we will see the euro continue to depreciate against other...
Particularly the yen.
Yeah, particularly the yen. I think the yen stays stronger for longer. I think that's, counter to some of the consensus out there. It's counter to what the Ministry of Finance wants. But ultimately, if we look at what the yen does, the yen is negatively correlated to what global growth does. When global growth is strong, the yen tends to be weak. When global growth is weak, which is what we're heading into, the yen tends to be strong. So certainly, euro-yen lower.
I was reading your notes, and it said that you said fade rallies. Now, tell me what fade rallies are and what you should be doing with them.
Yeah, I mean, absolutely fade rallies. I mean, fade the optimism. When markets rally on the back of optimism that this EFSF might be expanded or might be, leveraged up, and quite simply leveraged up, should be scaring people out there. When markets rally on that news, it's a good time to, to lift positions, to sell, or in fact to go short on those trades. And going short euro, going short euro-yen, going short euro against Asia are the trades that we favour on that.
So, yes, and where do you see that, just in terms of the dollar, the Aussie? We've seen the Aussie come down. Does it represent a buying opportunity, or do you wait for it and then wait for this fade rally to come in and sell?
Well, look, I think the Australian dollar is going to outperform amongst the rest of the G7, but certainly as the globe slows, as China, as the rest of Asia starts to slow a bit as well, then the Australian dollar, which is a leveraged trade on what's happening in the global economy, is a leveraged trade on what's happening in China and Asia, is certainly going to come under further pressure.
Let's also talk a little bit about China. I think over the last 3 months, as we end this quarter, if we have your report card on China, it does seem as though we're getting more and more bad news coming through the pipeline.
Yes, certainly we're seeing a real flattening off. I mean, the PMIs, I think, are the key. They're the forward-looking indicators.
We're expecting one any minute, actually.
Yes, absolutely. So we get that, and then next week from the rest of the region. What we have to remember about China is this last 5 years, China borrowed from its future 5-year plan. It boosted investment spending at a time when external demand was weak. For China to continue to grow at this strong rate at 8 or 10%, it requires a return of global demand. With the global economy now looking soft, that's not going to happen. So we must be pricing in a softer outrun for the Chinese economy over the next few years.
So where'd you go? I mean, you like the Aussie dollar, but that's not going to be that great if it's going to outperform G7, so, but it's not going to be that great if we have a Chinese slowdown.
Well, we have a Chinese slowdown. I think part of that is priced in already. I mean, certainly we've seen that over the last couple of weeks. We're looking for, to be short of G3, G4 currencies against Asia. We think Asia still has, inherent strength in it, still has current account surpluses, still has, very strong reserves, to bolster it, and it still has plenty of capacity and fiscal stimulus to get these economies moving. So it's, short of G4 against Asia.
I'm just, we sit here in Hong Kong. We've got the dollar peg, US dollar peg, of course, and there's a lot more noise coming through and people questioning that. What do you see?
About the peg? I mean, well,
yeah.
Look, certainly as we've seen, and we're talking earlier about equities. I mean, the volatility in asset prices is the volatility in assets is the price that Hong Kong pays, for its peg. But it has served the economy very, very well over the last, 20 or 25 odd years. I don't see that changing in the short term at all.
But there is more noise, though, isn't there?
Look, there's certainly more noise. There's always more noise when markets are volatile. But changing a regime when things are volatile would be exactly the wrong thing to do.
Thank you so much, Patrick Bennett from CIBC.